So how do we predict tomorrow's market, which is essentially what we're trying to do? I'm going to give you an example here. This is not the way we do it, but it's an oversimplified example to make a point. If I said to you the S&P has never gone down 9 days in a row, so in how many, 10, 20, 30, 40, in all these years, never gone down 9 days in a row. Every time it gets to the 8th day down in a row, it always goes up. And if today represented the 8th day down in a row, would you have confidence to buy tomorrow at 8 a.m. and sell at 3 p.m.? Again, this is not exactly how we do it, but it's the same kind of methodology where we use statistical analysis that says when this happens, statistically, this is going to happen with, say, a 75% likelihood. These are patterns based on repeating human nature that enable us to predict the pivot points of fear and greed. Remember, the markets go above and below. It's like a rubber band stretching. We can tell when it's gone too far above the average and it's going to snap back. When it goes too far below, it's going to snap back to the average. Does it happen every time? No. Nothing's guaranteed, but statistically, the way we trade, we're getting something like 66% of winning trades, meaning that there's a 2/3 chance that we're going to have a winning trade based on the methodology that we have developed. Now, this has been based on 30 years of testing. So you could go back 30 years and you could laboriously go through each day and you would get the kind of results that we've had. There are no opinions, no emotion. It's pure mathematics. We have a formula that says when a certain pattern of trading, such as it's gone down 8 days in a row, we're going to act the next day. Again, our formulae are more complex than this example, but it's the same concept. This is another example of how we actually predict tomorrow's market. For example, if the market has been going down from Monday to Thursday, it's going down Monday, going down Tuesday, going down Wednesday. On Thursday, let's say it turns and it looks like it's going to go up. This is when we would make our prediction. So from Monday to Wednesday, we would be neutral. If this was crude oil, we would be saying, do nothing on Monday, do nothing Tuesday, do nothing Wednesday. On Thursday, when we see it turn, we can make our prediction, and we create a spreadsheet every night. And in this case, Thursday, we would put the spreadsheet on YouTube saying that we believe it's going up. And if it goes up above a certain amount on Friday, we're going to buy and go long on this trade. Of course, the question is it going to go up? Or is it going to turn and go the other direction? And this represents a winning trade versus a losing trade. We talked earlier about a methodology using YouTube. In this case, I'm looking at, and this is test data, this is not exact data, although the spreadsheet looks just like this. But I'm using a simplified example. This is, say, Sunday, December the 31st, 9 p.m. In other words, we're about to start the year. We trade in blocks of $50,000. Our minimum is $100,000, but for the purpose of explaining, I'm going to use a $50,000 trading block. And as you can see, the beginning balance is $50,000 and the year-to-date return is 0. I'm only going to look at the S&P, so ignore bonds, crude, and dollars for now. They would have instructions. But for the purpose of explanation, I'm only going to use the S&P 500. Flat means we're not long, we're not short. It means we are neutral. The signal for the 1st of January is if the close tomorrow is above 1125, then buy at the close. The close is a set time of the day. In the case of the S&P futures, it's 3:15 Central Standard Time. So what we're saying on Sunday night is if the S&P closes at 3:15 p.m. above the price of 1125, then we are going to buy. To prove, and I mean 100% proof of our past performance, and this is how we do it. And it's a little complex, but I'm going to try and explain it in a simple example. This is the spreadsheet that you will see posted on YouTube every night. We actually take a video of opening the email. Steve Wright emails me the spreadsheet every night approximately at 9 o'clock. And I open the spreadsheet from my email. We show you the date of the email, which is proof of when the email was sent. The attachment is from the Google server, which is additional proof that it was sent on that date. And then finally we post on YouTube, and YouTube puts a timestamp that says that this video was posted 9 o'clock on July the 20th, 2011, or whatever the date is. So we are posting our spreadsheet on a public database with a timestamp. It is impossible to modify the video that goes to YouTube. If we were to modify it the next day, it would show that it was posted the next day. So we're essentially making a prediction on tomorrow's marketplace. We will then trade that prediction, and we're going to show that with a simple example on our actual spreadsheet. This is now the spreadsheet for Monday night, the 1st of January. Recall the last spreadsheet was Sunday night with our essentially our prediction on the S&P 500 that if it closed above a certain level we were going to buy. Well, in this case, it did close at 1130 at the 3:15 time on Monday in the afternoon, and we did buy. And the entry price on the spreadsheet shows that we bought at that price. Of course, this price, the close, is available publicly on any financial website. So you can then look at any financial website to prove that the S&P futures did close at the price that we said, and we said we were going to buy if it closed over a certain amount, and indeed we did. Now this spreadsheet comes out at 9 o'clock, and of course the market continues to move. In this case, the market kept moving to 1140. We entered at 1130. That's a 10-point move in the S&P futures, and that represents $500 gain. As you can see, our equity is now $50,500, and we are up 1% year to date. This is an unrealized gain, meaning we're still in the trade. Notice place the stop loss at 1110. In other words, if it goes the wrong way and drops to this amount, we get out of the trade. Now let's look what happened on Tuesday. So this report comes out Tuesday at 9 p.m. and as we can see that the S&P went up to 1170 at 9 p.m. on Tuesday, which means we're now up 40 points, which in S&P futures terms is $2,000 per single contract. We're always talking about a single contract in this spreadsheet. And that places us at 52,000 total equity, which is 4% year to date. And notice that our stop loss has moved up. Again, this is based on the formula. But now notice we have another instruction for tomorrow. Notice the signal is always for the day after. So here we are on Tuesday, the 2nd of January, 9 p.m., making our prediction. Signals for the 3rd of January, the next day. And the signal is if the close is below 1160, we're going to sell and exit. So again, this is Tuesday night. What we're going to do on Wednesday, this gets published Tuesday night on YouTube as proof. Our system now our methodology has predicted that if it closes, it's time for the system to exit. Now let's look what Now we have the posting on Wednesday night, the 3rd of January, with instructions for what to do on the 4th of January. And this will really tell us what happened on Wednesday. And indeed, the S&P 500 did close below 1160. In fact, it closed at 1155. And we posted that. We said we would exit if it did close at that. So we're now posting the price that we did exit. Remember, these numbers are available on any public database, any financial database. So you can go look at the S&P 500 for that date and prove that it closed at that price. This is sample data, but on the real spreadsheets, you'll be able to track this exactly. I'm using a simplified example that shows now we made 25 points, which represents $1,250 profit. It's now a profit, not an unrealized gain. And the balance is 51,250, representing 2.5% year to date. So as you can see, you could go through every video and look at that we've predicted what we think will happen the next day, and then if it did happen, we post the prices based on public data and show the entry and exit and profit or loss and show the balance. So when we make a claim that we are up 10 or 12 or 20% year to date, it's proof. You can go back and relive every video and prove that we called it the day before. Of course, anybody can call it the day after. We call it the day before, we publish it the day before in a format that cannot be modified, and then the next day we show the results of our methodology with the entry, exit, and profit prices.
This is the end of part 2. Please continue to part 3 for the very brief final video.